What's good, hustlers? It's your boy, Sir Willoughby, and welcome back to the Hustle House on the Stock Hustler Network. I'm glad to bring you some Monday market madness because this week will be crazy. As you already know, the war in Iran has started over the weekend. Yeah, that's right. The war in Iran has started over the weekend. Israel and U.S. conducted some strikes on Iran this past weekend, and the war has started. It actually has killed the supreme leader, according to sources on CNN. Man, a lot has been going crazy, and you know what happens with war. The market tends to sell off, but it also tends to rebound. It's a lot of money that can be made at this time. There's a lot of money that's being made at this time. Before we continue, I want to let you know that today's program brought to you by the NexGen school community. Tap in with NexGen traders. The link will be in the description below. Come over here. Let's learn. I'm finishing up my options course. Everything should be uploaded in the next coming days so you can learn how to jump in right in where we at, trade options, go from a beginner to semi-expert, start learning how to make money in the market with the plays that we do. Start learning how to invest and building a foundation. So I got that over here in the Next Gen Trader School community. Come on over, let's learn, let's become a Next Gen Trader. Let's get back into it, man. I got a few notes right here I'm gonna read off of. But February was a bloodbath. You know what I'm saying? February is in the books, and for the tech, it was a straight bloodbath. We just wrapped up yet another losing week for the Nasdaq as investors bailed out crowded AI trades and high multiple tech names. Even on days when the indexes bounced back, under the surface, you had heavy selling. You had in semiconductors and in software. With that, AI spending is getting ahead of actual profits and valuations. Simply ran too hot. Um, uh, another aspect we can look into is Nvidia. Nvidia had great earnings, but had an ugly reaction. Why is that? Nvidia did what Nvidia always does: blow out the numbers. They posted fiscal Q4 2026 earnings last week, had about 1.62 a share up more than 80% year over year, on roughly 68 billion in revenue, up 70%, and guidance was higher for next quarter. So why did they sell off? But instead, for the victory lap, the stock sold off hard the day after it reported, at one point wiping out 260 billion in market cap. God, in one day. And it was dragging the whole market down with it. Even though they beat on revenue, earnings had laid out a bigger AI data center opportunity with Blackwell and Rubin platform. So that's what a lot of people are looking at. They focus on how they're going to move forward with their data centers because data is ruling the world right now. This is a classic late cycle behavior. Great numbers, great guidance, but the bar was so high that any hit of competition or AI fatigue triggers profit taking. I say this, and I said this right before the crash happened in my last past few videos. Take profits when you up certain amount percentages in these plays. Yeah, you can have long term valuations. You can have long term investments, but take profits as you're going, as you're holding. Don't just let the play fall and you give all those gains back to the market. You got to know when to take profit, know when to fold them, know when to hold them. You get what I'm saying? So that plays the same type of aspect in the stock market. You got to know when to fold them. You got to know when to hold them. Let's continue. So you got bad inflation vibes. Fed is holding rate cuts from January. January we had a rate cut hold. So we're gonna see what they're gonna do in March. On the micro side, the data did the Bulls no favors. The data did the Bulls no favors at all. Producer price inflation for January. So that's the PPI data. The PPI data for January is tracking around 0.3% month over month and about 2.6% year over year, with a core PPI also running at 0.3%. Not a disaster, but sticky enough to keep the Fed on edge for not cutting rates and potentially talking about hikes. That PPI comes in I think PCE comes in this week. So PPI feeds right into the Fed's favorite gals, the PCE inflation, where markets are bracing for headline PCE. So PCE is coming up this week. So be on the lookout for that, along with the war and the other economic data that we have going on. It's going to be a highly volatile market this week. You got around PCE bracing in around 2.7 year over year and core near 2.8%, still above the 2% target. So we're still high on PCE, and if we come in higher, it's gonna be a red flag for the Fed. The Fed, meanwhile, has paused the rates. They held the fund rate at 3.5% to 3.75% at the January meeting after three cuts late last year. And recent commentary says they're willing to stay tight. They're willing to stay tight or even hint at rate hikes again if inflation doesn't cool. So the backdrop for this selling off is simple: high AI, sticky inflation, and Fed data coming in, a Fed that's not in a rush to bail out the stock market. You got a Fed in the rush, not to bail out the stock market. So they paying attention solely to the economic data because they don't want to get in trouble and they don't want to trigger inflation or recession. We already got inflation, a recession. What to watch this week? Going into this week, I'm watching three things, three simple things. First, follow through on the tech slide. Does selling continue in semis and AI software, or do buyers finally step in after the February's flush and actually come in and pick those 52-week lows up, those 3 month sell-offs up? We're at 3 month lows on a lot of plays. We're at 6 month lows on a lot of tech plays. So will the buyers come in this month, step up and get that slack and get those cheap shares and actually drive the market back up? Second, any fresh inflation or labor market data that could shift expectations of the March Fed meeting, especially as markets handicap the upcoming PCE release this week. So we will be paying attention solely to that PCE data and what they're talking about once it's released. That's going to let us know how the Fed move forward. So let's hustle. Keep hustling with me. Third, stock specific catalysts and big AI fintech names. We are starting to see big depression instead of everything going up together. So you're starting to see more plays. Okay, this sector is kind of running up. You got 5 or 6 plays in this sector, but 6 or 7 plays in this sector selling off 5 to 10% a day. So you have to keep your eye on that. The market is not all running up at once, but it is some stock that is making great moves in these hard times. So you just got to keep your eye on. Now let's zone in on a few names. I'm watching for trades and potential investments in Google, AMD, SoFi, and I love Rivian. So stocks to focus on. We're gonna run this down real fast. I ain't got that much time. Starting with Google, Alphabet just delivered solid Q4 numbers. Revenue and earnings per share both beat. Google Cloud grew close to 50%, driven by AI products and Gemini integration across the Google ecosystem. Google Gemini is embedded in all Google's products, just darn near, except for YouTube yet. I don't know. I paid attention to it, but it could be coming. Despite that, the stock recently traded around the low 300s and dipped about 2% as investors freaked out about the heavy 2026 capex guidance in the 175 to 185 billion-dollar range, and some insiders started selling. Always keep your eye on insider selling. Sentiment in February has turned cautious, with some commentary noting the stock down roughly low double digits from early month highs, but most analysts still have a buy rating with the target in the mid 300s and see Google as one of the potential leaders in the AI coming in 2026. I agree with that. I totally agree because Google played on the back foot for a year and a half with the AI infrastructure. They wanted to wait and see how everything played out. Kind of played it like Apple, but Apple waited too long. Google played it and had great timing with this. So for traders, I'm watching. So NexGen traders, let you know, I'm watching the 290 to 305 zone as a key demand area. Mentioned in recent position chatter, if we hold their short term bounces back toward 330, 340 on the table, if that breaks, you treat it as a long term dip buy story rather than a quick trade. So if it breaks below the 290, we need to start just dip buying on this thing because we already know that with the catalyst and the news it got, potentially we're gonna get that good rebound up. So that's why I'm looking at for Google. AMD, next up is AMD, which is right in the middle of the AI arms race. Yes, it is. The big headline, AMD just landed a massive multi-year AI chip deal with Meta. That's amazing. Tied to up to 6 gigawatts of 6 gigawatts of instinct GPUs of their data centers, a billion that could be worth over 100 billion in valuation over time. Shares jumped up Friday roughly 9% on announcement as the market woke up and to the idea that AMD is now a true contender in the high-end AI accelerators, not just budget alternative to Nvidia. So it's basically just letting everybody know that hey, AMD is a competitor. AMD is in competition. AMD will not be left behind. Meta also negotiated the right to buy up to 160 million AMD shares at a penny each, roughly a 10% stake in the company. If certain chips shipment and stock price milestones are hit, that's a huge vote of confidence for AMD's roadmap, but also a reminder there's potential dilution down the road. So that's a reminder to say, hey, if Meta's buying at a penny a share, 10% stake, that roughly down the road, shares will decline because Meta, they got to be cheap enough so Meta can come in and buy the shares that they need to buy. So it will be a lot of selling off coming in if this is true and they continue with this catalyst. For the trade, AMD is a pure AI infrastructure momentum. Dips after broader tech sell-offs could be opportunity as long as Meta deal narrative stay intact. But you have to respect the volatility because the stock has already run on the news. So you should see a slight pullback, and we should find these levels from the recent run up from the 9%. So let's look at SoFi shifting into fintech. SoFi is a high beta name that's hit hard this year, but with improving fundamentals underneath. The company just reported Q4 2025 revenue at about 1 billion in its first $1 billion quarter with earnings per share of 13 cent and about 1 million new members added. So SoFi is so great to the point that it's just now SoFi has been beating earnings for the last year and a half. Once it became a profitable company at the end of 2024, end of 2023, and they became a profitable company, they have been hitting earnings and growing every quarter. Despite roughly 40% year-over-year revenue growth and stronger 2026 guidance for around 30% revenue growth and more than 50% adjusted um, EBITDA growth, the stock actually sold off post earnings. It's crazy. It slid from just under 30 at the start of the year to the mid teens by mid February. So I'm seeing this as a great buy and whole area for me. I'm not looking at SoFi to trade in these areas, but I'm looking at it to start accumulating more in these areas because it's now letting me know that it's a competitive fintech company. It could be one of the best in its field. Analysts are split. Some see this as an opportunity with JP Morgan boosting SoFi to an overrate and slapping the $31 target. We got to take the analysts' price targets with a grain of salt, but they're saying that this thing probably could potentially go up to $31. You got Citizens and JP Morgan going to outperform with the $30 target, both implying roughly 40% plus upside from the recent levels. From a trading angle, SoFi is a buy the fear candidate. It's above single digit lows from 2024. It currently sits below key moving averages with the RSI nearly oversold, which sets up for sharp squeezes if sentiment flips or if the index inclusion chatter stocks up. Finally, we got Rivian. You know I love Rivian. It's my baby. The stock has been a roller coaster as investors weigh EV demand, crash, burn, and execution on the upcoming R2 launch. So the launch was supposed to come out in January. They were supposed to release the new R2 compact SUV, which, which has been temporarily delayed. So you got in early February, Rivian popped out 9% in a single session during a broader market rebound, helped by optimism around new leadership hires and its plan to expand the R2 SUV into 2026. But it's still choppy. On another day in February, the stock closed over 7%, even as several analysts raised price targets. With the market laser focused on free cash flow burn, with some estimates see pushing above 4 billion, and the risk that R2 sales could miss consensus for 2026, 2027. So Rivian sold off a little bit, a lot actually, because people are kind of afraid that the new R2 won't produce the amount of sales that it's valued at. For traders, Rivian is a classic speculative EV swing. You know, if you're trading, if you're not an EV guru like me, if you're not all the way in Rivian like I am, because I believe in the company actually, and I like the moat, and I actually like the car. For traders, Rivian is a classic speculative EV swing. You play it around catalysts like production updates, R2 timelines, and micro risk on days. But if you're treating it as an investment, you have to size it small and accept your multi-year execution risk. You get what I'm saying? So please play it small. Please play it light if you are playing with Rivian, because it's highly volatile. All right, so to wrap it up, for this week, Hustle House Tech just locked another rough stretch. February was brutal for the high flyers, and even monster earnings for Nvidia's couldn't stop the selling. We've got sticky inflation data on the Fed hold at 3.5, 3.75%. In the market that's finally forcing you to be selective instead of just buying anything with the AI name behind it. So you gotta watch what you buying. You gotta watch how you buying and how you getting in these plays. You can't just go in and buy anything like you did last year or the year before. Names like Google and AMD sit at the center of the AI infrastructure, and you got software stories. While SoFi and Rivian give you higher risk, higher beta exposure to fintech and EV growth. As always, none of this is financial advice. Do your own research. I'm not a financial advisor. I can't tell you to buy, hold, or sell any assets. You got to make that educated decision on your own. Manage your risk. I see you next week on the Hustle House, and I drop some more this week. Peace and love. Hope everybody have a great day trading. Watch your investments. Pay attention to the news. Watch the markets. Let's go. Peace and love.